And then, of course, the question is, given that, how do you regulate it to be able to ensure that the capital can move in a very efficient manner, but also is used in an inherent and safe and contained way?
From all of your experience, what separates the current era of stablecoins and why they're such a positive impact versus the potentially treacherous CBDCs that we had seen in the era of 2019 to 2022?
Again, we're still so early. It's funny how to us 280, 290 billion in stablecoins is so big, but in the trillions that currencies live on, it's tiny. So we have a long way to go.
Welcome back to The Roll Up.
This is your home to learn from the biggest guests, the brightest minds at the tip of innovation.
Our goal is to help spread the collective knowledge of everyone in our community.
We are breaking crypto out of its echo chamber and taking it to the real world.
Thomas Cowan, welcome to The Roll Up. I'm super excited to have this chat. I don't think we've ever had someone who has been at the Federal Reserve and also Ripple and is now the head of tokenization at Galaxy. That is a very unique position that you're holding in the industry. So it is a pleasure to have you here on The Roll Up.
Of course, Robbie. Thanks for having me, and excited for the conversation.
Absolutely, man. I mean, we were just talking before this, bull market, it's good vibes. We're enjoying the times. I think we all grind through and survive in some of the tougher market conditions to make it out and enjoy some of the things that are happening today. Bitcoin is breaking new all-time highs. Things are generally trending up and to the right in a very positive direction. And it's not just market prices that are up and to the right. It's the actual use of this technology. Hester Pierce is talking about cryptography and privacy. I remember Gensler, and that was kind of all I knew as an SEC chair. And now, we are very much in a different set of circumstances. Before we get into kind of the current moment here today, it's your first time on the show. Maybe you could give us a little bit of a background and kind of a walk through your very storied history and experience leading up until this point. Thomas, how did you find yourself leading tokenization at Galaxy?
Yeah, absolutely. Happy to give a quick background. I love how most people in this space have a story of, they had their old career and then they kind of went deep down some rabbit hole and then, the rest is history in terms of going deep into crypto. And for me, it was when I worked at the Federal Reserve on their crypto team, and then I worked at Ripple, and then was at Paxos, helping build out their stablecoin strategy, and then finally ended up at Galaxy, helping build out the tokenization team here. And so, been in the space for about 5 or 6 years at this point. And to your point, this industry has its highs and lows. And so it's wonderful to be at a relative high at the moment. And one thing that's exciting is I do feel like this time, we have a lot of wind at our back and that we have increasing regulatory clarity. We have, the technology has really reached a level of maturity that has much stronger than previous cycles. And then we have institutional adoption and interest that we just haven't seen before. So you put those three things together and it really creates, an environment that allows us to really run with it and build out the technology and the adoption that we've all been looking for so long.
Yeah, there's been a flurry of news from the very core financial infrastructure that has underpinned our just not TradFi, not DeFi, just finance in general. The SEC is considering allowing stocks to trade on chain, incorporate some sort of stablecoin collateral potentially. I've heard things from the NASDAQ. We're also on the brink of 24/7 trading for a lot of these equities. So it just feels like we're starting to realize the effects of this technology. We've seen this being understanding of blockchain for a long time. We've seen where this is headed. It finally feels like the rest of the world is catching up. I want to get a sense of where you were when you were at the Fed and you were working on crypto. I take it was probably a rather small team and a pretty tight-knit community at the Fed that was working on the crypto initiatives at the time. When were you there? And generally, what was the vibe? Was it still trying to parse out stable coins versus CBDCs and central bank digital currencies? Maybe you could kind of untangle this web of how things were back then.
Yeah, so it was actually on the Project Hamilton team that looked at CBDCs specifically, and it wasn't pro CBDC or anti CBDC. It was more, hey, let's look at this technology, see where it applies, and see how it can impact the role of currency and the dollar more broadly, not only here in the U.S. but also on a broader scale across the world. And so the mindset really was, what is this technology and what could it unlock? And so that's kind of the mindset that we had there, and it gave me a lens through which to look at the existing financial system, how it has evolved over the decades, how technology has played that role, and then as importantly, look at crypto and say, okay, how can blockchain specifically help improve the system that we have today? And it's less of, hey, let's completely upend the system, and more, let's improve it and cut costs, boost revenues where we can, and increase availability to different investor classes and different people all over the world. And so that's kind of the mindset that we took. And now that initial kind of 2020, 2021 kind of mindset that we had, we're finally beginning to see that begin to bear fruit as we get regulatory clarity, as we get major financial institutions that have helped define the U.S. economy more broadly and finance more broadly, really begin to think about this and recognize, wow, this is no longer just a technology or science project on the side, but increasingly technology that we're going to adapt into vast parts of their business lines more broadly. And we're still super, super early, even though for those of us in the space, it feels like it's been a long road. I think it's just exciting, really, what we're going to see and how quickly it's going to happen once we really get people to buy in and see the potential this technology has.
Could you tell a bit more about the story of Project Hamilton? Where did the directive come from? Where did the order come from? On the food chain at the Fed, did it come from the very top? And then maybe you could explain what the outcome of Project Hamilton was. What were some of the findings and the conclusions that you drew? And we'll maybe parse that into and catch up as to where stablecoins are today.
Yeah, totally. So it was very much looked at as a research project team within the Boston Fed in partnership with the MIT Digital Currency Initiative. And so the approach was, from a tech perspective, what can this technology do to help move currency more efficiently across the world and domestically as well. And there were a few main takeaways that we had when we published the paper in February of 21 or 22 now. It's been a long time. But the couple of takeaways were, for starters, with a product or currency as liquid as the US dollar, it means that the kind of speed and the volume that you need, frankly, doesn't work well on a blockchain. For the TPS that you would need for CBDC, a retail CBDC specifically, you'd need at least north of multiple millions of transactions per second. For context, Visa, last time I checked, could handle up to 60,000, but they average closer to 6,000 to 10,000. So just it's a few orders of magnitude greater than what blockchains could handle. And so one of the biggest conclusions was maybe blockchain actually isn't the best use case specifically for retail CBDC. Another big takeaway was it's rare that we would see an institution like the Fed face retail directly. It never has and is unlikely to in the future. And so one of the other takeaways was, that those roles would likely stay the same. And so it would remain intermediated by the commercial banking system. And so the other thing too is the timeline as well, highlighting that if this were to take place, you would need buy-in from DC and buy-in from legislatures and the executive branch as well. And so the timeline is long enough that at least I came to the conclusion that, hey, I think that the U.S. private sector is likely going to solve a lot of these problems that a CBDC might, if it were moving a little bit faster. And so at least for me, that's when the light bulb went off of, I do see a dollar moving on chain. The question is how and in what use case. And that's really when I kind of went down the stablecoin rabbit hole, and I'm still very much involved in stablecoins and think that they are going to be one of the key ways we move and store value going forward. That being said, I think that we're going to continue to move value on the old rails for a long time, similar to how people still cash checks, people still use wires, when in reality Venmo and other payment platforms do move faster. So I think it's another avenue through which to move value, but it won't be one that replaces all of the others.
Hibachi.
Provable. Trade perps with speed and security. Earn rewards. Visit hibachi.xyz. Trading on fire. The wait is over. The Talus testnet is live. Be part of the revolution. Join now at testnet.talus.network.
The future runs on intelligence. Creativity, engineering, health, money, productivity. AI promised utopia, but delivered only hype. Black box models and zero accountability. With tons of tools claiming to be the best, how do you know what's real? Introducing Recall Find. Top models ranked by transparent reputation from researchers, users, and developers. Test AI skills, curate favorites, and compete to see what works. Don't guess what's good, recall it.
Got it. That makes a ton of sense. And now we also have people directly in Washington. We have Secretary of the Treasury Bessent speaking about the scale at which they're going to issue stablecoins to the tune of $3 trillion by 2028. There was recently a tweet by Naval that said stablecoins are just CBDCs with extra steps. As someone who worked at the Fed on Project Hamilton, did intense research into CBDCs, and then went on to work at Paxos, significant issuer of stablecoins, and now, again, head of tokenization at Galaxy. Is there truth to that? Getting back to the basics here, what separates a bad CBDC from a good stablecoin?
Well, there's a lot in that question and a lot to unpack. One thing I would focus on is at the end of the day, when you build a new technology, it can be used in a lot of beneficial ways, and there are also risks with any new technology. And the question is, as it evolves and as it is created, you need to make sure the industry uses it in ways in the most, in the best way possible, innovating and pushing the ball forward, while at the same time having regulators come in and create the rules and the regulations that put up walls to ensure that it's used in the best way to benefit, the consumer base as much as it can with limiting the drawbacks. And we've seen this over and over and over with new technologies, going back from, Visa starting in Fresno, California to the rise of the internet, to Uber, over and over and over. We see that, technology racing ahead of regulation, and then regulation catching up. And it's just kind of a constant, give and take. And this is no different, where people are recognizing, especially those of us who've been in the industry for a long time, recognize the benefits of this technology. And the question is how we make sure that we create a regulatory environment to maximize the best part and minimize the risks. And I think increasingly in the past couple of years, and this year specifically, we're beginning to see that really bear out, whether that be in the US or Europe or Asia more broadly, where people are beginning to recognize the technology and help put in rules to embrace it and incentivize innovation as much as possible.
Yeah, absolutely. I think the regulatory environment is something that there's no doubt, there's no objections. It is certainly fostering innovation. And one of the things that I think was extremely positive that, frankly, the market reacted negatively to, which makes a ton of sense. But I think just on a pure first principles basis, the SEC saying that they're going to start to investigate 200 plus digital asset treasury companies for insider trading because of some of the movements that took place ahead of them announcing their crypto strategies. It's like, yeah, that is common sense regulation. That's not regulation by enforcement. They're not saying just, letters out the wazoo to these companies. They're saying, we're going to go investigate it. We're going to find out what's going on here. And that's not going to slow down the rest of the positive innovation that's happening on the rest of the industry. I do want to just double click on this question though. Like, what's just kind of catching up the last couple of years, what separates and fostering innovation, certainly, as people in this industry, is super helpful and super healthy for this industry to kind of foster, sustain, and grow. But from all of your experience, what separates the current era of stable coins and why they're such a positive impact versus the potentially treacherous CBDCs that we had seen in the era of 2019 to 2022?
Yeah, I mean, I think zooming out, thinking about what currency is and what a dollar really is, when most people think of a dollar, they think that all dollars are the same. In reality, a dollar in your PayPal account, a dollar at JP Morgan, a dollar in your wallet, and a money market fund all are equal to a dollar. But in reality, the risk profile is very different. They're intermediated by a different system. And so it means that while from an accounting perspective, that's all a dollar. From a risk perspective, it's very different. And so when you think of a CBDC versus a stablecoin, the risk perspective is also different, right? By definition, a CBDC is a liability, a direct liability of a central bank, whereas a stablecoin is a liability of a private issuer, a Circle or a Tether, that's backed by cash, repo, and treasuries, right? So it really just depends on how you define what a dollar is and how it's treated. And then, of course, the question is, given that, how do you regulate it to be able to ensure that the capital can move in a very efficient manner, but also is used in an inherent and safe and contained way? And so that balance, I think, is one of the biggest challenges that we're going to have as we see the movement of currency, moved on chain. I think the extremes usually people agree with that there should be some way, like cash is completely anonymous. I would love for that to remain the case. But at the same time, when you move vast amounts of money, most people would say, yeah, if you're moving a ton of money, it would make sense to make sure that there are KYC and AML checks for that, right? So like those extremes usually most people can get on board with. It's the middle that really things get interested in what those use cases are. So just like any other technology, we've shown what the benefits are and what the possibilities are, and now the question is how we come together to leverage it to upgrade the system while minimizing the risks.
Right. Yeah. I can see the current dynamic of private issuers of stablecoins creating somewhat of a fragmented system. That we've had this conversation about private issuers going all the way down Walmart stablecoin, Amazon stablecoin, the Meta Libra project being revitalized, and seeing all of these things. How do we maintain fungibility across them? Could lead to some issues. But then again, the CBDC certainly has its issues with surveillance, state potential outcomes. Mm-hmm. So there's certainly a lot of nuance here. But just to be reductive for a moment, Naval's tweet, fact or fiction?
I mean, honestly, I have to dig in more. I think at a high level, I look at it very much as a tech perspective of, okay, how can we leverage this tech to be as beneficial as possible, and really think through what it can be. And one thing that's exciting here at Galaxy is, well, the industry's really found product market fit with stablecoins, as a more efficient way to move money as overseas dollar access in emerging economies, and as a trading pair for Bitcoin, Ethereum, and other digital assets. We're really beginning to unleash what this technology can do beyond stablecoins, money market funds, debt, tokenized equity, and beyond. And so we're really excited to see what, given the past of showing that stablecoins have that future going forward and that growth, now really what we can do more broadly across different financial assets.
Very, very diplomatic answer. Really appreciate that. And I'm curious, when you're looking at the U.S. market, this is certainly a result of the regulation and the developing landscape that we're having here, and really fostering innovation. We're seeing private issuers coming out all over the place. And it is really, really cool from my perspective to see the private and public markets go head to head in stablecoins. We're seeing Wyoming, the state of Wyoming issue there's a publicly issued by a state government stablecoin. At the same time, we have Circle, one of the largest IPOs this year, private company launching stablecoins. So the Wyoming currency and effectively still the US dollar, but the Wyoming stablecoin, the USDC, these are going to go head to head. And this is how things are playing out in the US. We have a very capitalistic attitude. It's really cool to see. Other places, for instance, Europe, there's kind of speculation. They're kind of toying with this idea of a CBDC. They haven't fully embraced a full privatized stablecoin market as of yet. How do you think the non-US dollar denominated stablecoins, how do you think that landscape might play out? And then I'd love to go on to some more broader strokes tokenization combo.
Of course. So I think one thing to think through is, in many ways, we're kind of in the wildcat era of banking, where we're having a privatized version of the dollar to an extent. And I think what will end up happening, in the beauty of the Genius Act, is the goal is to standardize all of that. So we can go back to thinking of a dollar as a dollar, just like a dollar at JP Morgan and a dollar at Bank of America trade equally, even though they're liabilities of different institutions, right? So from that perspective, you and I, when we think of money in a bank account, we think of it as standard, when in reality, it is at different institutions, right? So that I think is where we'll end up. And in terms of on the Europe side, actually, one of the big initiatives that I've led here at Galaxy is helped form a joint venture with DWS, which is the asset management arm of Deutsche Bank, Flow Traders, and Galaxy, to form a joint venture and launch a euro-denominated stablecoin called AllUnity. And we chose to launch it in Germany with a BaFin license in the MiCA regulation. And it's euro-denominated, and really we saw that, if you look at Europe today, it's still frankly dominated on chain by the tethers and by the USDCs of the world. The euro-specific stablecoins are still pre-limited. And so we saw a big market opportunity, knowing that, hey, as the market matures, there's likely going to be demand for euro denominations on chain. And so that's one thing that we really are excited by and continue to see grow after our launch this past July. And I think the fun part is, long term, we're likely going to see, the amount of on-chain currency match off-chain currency. So we will see more and more currencies come on-chain, and then FX markets will emerge and the like. But again, we're still so early. It's funny how to us 290 billion in stablecoins is so big, but in the trillions that currencies live on, it's tiny. So we have a long way to go.
Wow. So the amount of on-chain currency flipping the amount of, or coming to par with the amount of off-chain currency. Where is it right now? Is it 80-20? Is it 95-5? Is there any?
It's fractions of a percent.
Yeah.
It's not even close. And we have a long way to go, and we're excited by that, right? Because it just means there's a lot of opportunity there, and as we know, stablecoins are the part of the industry that has the most product market fit, where people very clearly do see it as a more efficient way to move value across borders. They do see it as a more efficient way to get overseas dollar access in emerging economies with weaker currencies, and they do see it as a more efficient way to buy Bitcoin, Ethereum, and other digital assets. So it's found product market fit, and that's just the beginning, and we're really going to see it grow substantially as stablecoins become a means of payment and a store of value across different parts of the financial ecosystem more broadly.
Blockchain shortcuts, templates, and widgets launch without friction for builders by builders. Visit enso.build. Relay, low fees, lightning speed, and the power of multi-chain at your fingertips. Instant multi-chain payments. Choose any token on any chain. 75 plus networks supported. More than 5 million users. 8 billion plus volume processed. 70 million plus transactions. Fast, reliable, everywhere. Start swapping today. Only on Relay.
Absolutely. And this is a very similar premise that Secretary Bessent has talked about it. You're now talking about it now, scaling to 3 trillion, scaling it so that we're on par with the amount of off-chain currency. We'll bring it, I'd imagine, exceeding 3 trillion in quite some excess. And so starting from this premise, what are some of the knock-on effects of this? And I can just sound off just for a moment, and I'd love to get your take, because there's also, and I was in Asia. I was going to these conferences. I didn't get to go to the Network State conference, which I'm sure was really, really interesting, because this is essentially an economy and a network state that's already built on stablecoins. That is the lifeblood of the economy. It is kind of the national currency of each network state. Mm-hmm. And so I'm curious, as greater amounts of stablecoins are put into circulation on chain, this will inherently flow into the economies of network states, and not necessarily the economies of nation states, unless those nation states are on chain. And so to me, it's a slipperier slope for stablecoins to go into something like a Hyperliquid or an Ethereum rollup or an Ethereum ecosystem, rather than starting from first principles. We create these stable coins, we put them into circulation, and then they make their way into a money market fund or a stock indice, unless that thing is tokenized. And it's almost like this on-chain liquidity begets more on-chain liquidity. Are you thinking about the same way? What do you think are some of the knock-on effects of generating and circulating so much stablecoin supply, so that we reach this inflection point going from off-chain to on-chain?
Yeah, so I think when we think through any kind of technological adoption, that whether that be financial related or not, kind of the first wave is you look at what the technology's potential is and how exciting it is. And when the first iPhone came out, everyone said, wow, we don't know what all the uses will be of it, but we know it's fascinating. And then, then the App Store comes out, and then all the uses of the technology really unlocks. And we're in the same thing here, where people have shown that using a stablecoin to move money cross borders is just faster, better, cheaper than the correspondent banking system. So we know that that's better, but then what are the actual uses and the implications of that? That is the part that we're going to get into over the next, 18 months to couple of years, where people will say, wow, now I can just move money in a faster, better, cheaper manner. What does that mean from an economic point of view? And that part is when the technology begins to fall away, and people won't know they're using stablecoins. People won't know that that the back end of their financial life is on chain. They'll just know that they're able to pay their relatives more efficiently, that they're able to send money home, that they're able to pay for goods more efficiently. And it just means that the global economy can be even more integrated and have even less friction when you're moving value across borders. And so we're going to get to that inflection point. I think with stables, we're getting there in terms of seeing the use from just the technology. But I think in terms of other financial products, we still have a long road ahead. But we're beginning to see kind of the benefits of them come to life.
Yeah. There's been a lot of speculation that AI is going to lead to this, GDP increase and productivity boom as a result of the efficiency of the labor market, and basically, a lot of automation. But when we're thinking about capital efficiency, it feels like stablecoins are right there. Like they're a very clear use case for how we can make all of this capital flows more efficient. Maybe you could just close us out here. What are some closing thoughts? Do you think there's going to be categorical changes here? GDP increase, banking sector decrease as they get innovated? Generally, what are some conclusions that you draw? How do you put these things together?
Yeah, I think one parallel that I like to make, and I can steal from Jeremy Allaire, he always talks about how before the internet and after the internet, what it really did was once you could move information much faster, it meant the amount of information, increased by a large number, right? By like exponentially. And I think we'll see the same thing here, where because the cost to move money and the cost of payments will decrease so much, it means that people are going to be much more likely to pay fractions of a cent to access content, for example. And so that's for people. When you get to the AI end of things, there's no reason why you can't have AI agents paying fractions of a cent for access to certain information, or to get through a paywall, or to make sure you're not a bot, or whatever it is. And so I think we're going to see a merge of these two technologies that will be quite beneficial and create a lot of efficiencies. And at the same time, I think over and over and over, with every new technology, a lot of the time people think, oh, this is going to wipe out so many jobs and impact our GDP in X, Y, Z ways. And at least up until now, we've seen a lot of people been able to create new jobs, create new industries, and generally improve the livelihoods based on this new technology that we've seen. And I think this is no different. And at Galaxy, while I started focusing on stablecoins, we're now much more much broader, looking at money market funds and on-chain debt and tokenizing our own stock and all of that. And so while stablecoins is the first chapter, we still have a long road ahead, and we're excited to continue to lead the industry in that way.
Awesome. Thomas Cowan, thank you so much for coming on. Absolute pleasure talking about this induced demand as a result of making capital more efficient. Love to have you on again sometime soon. And just generally, as we're pushing beyond stablecoins and into money market funds and indices and bringing things on chain, we're moving at light speed, and there's lots to talk about. So thanks again for coming on.
Of course. Thanks for the time.